Hi everyone, and welcome to this video where we're going to be talking about counterparty risk, the risk of loss due to the default of a counterpart.
If I go to the Turkish bath, I risk enormément.
Yes.
First thing, there are different types of counterparty risk. The main counterparty risk is credit risk. You lend money to a client, he defaults, doesn't pay you back. Credit risk. But there are many others. For example, when you buy a government bond, you have a risk on the government, and that would be a risk on the issuer of the bond. This example, it's a specific issuer, it's a government, so it's called a sovereign risk. What other type of counterparty risk do you have? A delivery risk. You buy a bond, you pay for the bond, and you're not being delivered the bond because there is a default of a counterpart. Another type of counterparty risk is a country risk. Country risk, you finance the building and operating of a power plant in a country, and there's a war in the country, or there's a nationalization of the project you're building, and you're losing everything. That is also a counterparty risk, country risk. The counterparty risk is the main risk you have within banks. It usually represents 70-80% of the risks that banks have if you take into account counterparty risk, market risk, and operational risk. What ways do we have to mitigate, to lower, to hedge those counterparty risks? There are several ways. First one, most easy, would be a guarantee. When you ask a bank for a credit, they're going to ask you to get a guarantee. Specific type of guarantee you might hear a lot in the CIB would be collateral. We give as guarantee, for example, securities. Another way to mitigate the risk would be an insurance. We ask the client to get an insurance. Specific type of insurance, in fact, it's a derivative, would be a CDS, credit default swap, a way to lower the counterparty risk. So we listed a few counterparty risks, and we've seen ways to mitigate the risk. Now the question, do banks need to have equity in front of this counterparty risk to be able to absorb unexpected losses on the counterparty risk if they occur? Yes, they do, and that's all the Basel agreements. The Basel Committee at the beginning was created because of a counterparty risk. I encourage you to look at the Erste Bank default in 1974 on top of my head. And this is just after that the committee was created to tell banks, well, the more counterparty risk you have, the more equity you should have in front of the risk. And that was Basel I. It wasn't called Basel I, it was called the Cook ratio, where they say, well, the more counterparty risk you have, the more equity you should have in front of the risk. So to summarize, counterparty risk, risk of loss due to the default of a counterpart. There's several types of counterparty risks. There's different ways to hedge the risk, and banks are asked to have equity in front of these risks.
Et moi, I risque encore plus.
Yes.
Donc, I risk on the deux tableaux.
Yes.
Oui, mais enfin, vous dites toujours yes.
Yes.
Bah oui. Alors, écoutez.
If you'd like to have more detail about the way we calculate the amount of equity banks must have in front of this counterparty risk, don't hesitate, put comments or send me an email. I'll be really happy to answer. See you soon!